Thank you, Willa, for introducing me and for convincing me to be here tonight and talking about something I never talked like this before. It's a topic which is very huge indeed because it combines two topics which we believe are similar or are identical: the topic of money and the topic of credit. And now, tonight, for me, it's exciting. It's exciting in many ways because first time for me to give a talk on this topic. First time for me to give this in English. I had talks before in English, but not on this very complicated subject. And then the first time that I give a speech in Berlin, although I live in Berlin, so this is all very new for me. And I'm very happy to see you here tonight, although it's very warm outside. So if you suffer inside because it's too hot, I heard already it's getting hot in here as well. So please feel free to open the doors and to catch fresh air and dive back into the speech if you like. So what I'm willing to do tonight with you is I want to give you a very comprehensive insight into what money and credit creation is and what are the similarities, differences, combinations, the relations between those two. And then the second is I want to show you where the problem lies in terms of Bitcoin meets blue marble, in terms of money meets planet and people. Why is money and credit creation so difficult to handle in terms of achieving our sustainability goals? Is there any contradiction between the two? Is there any potential that we could use? Certainly, I believe there is, otherwise I wouldn't have invited you to this talk. And the third thing is, that is, I think, that is an experiment, a huge experiment. I want to try to invite you to prototype something with the knowledge that you gain tonight, which is, the ladder is quite high, so like this. Let's see what comes out of that. I believe that the principle is very simple, so if you once understood what credit is all about, credit creation is all about, I believe you will all be able to create credit tonight. And if you're able to create credit tonight, I think it's not such a huge step to create credit tonight for good impact. And that's the experiment which I want to take tonight with you, with your help. So let's see if we get there. If not, doesn't matter, let's just do a follow-up evening. So, hi. Hi. Come in. Hello. So that's the three parts I showed you. The first introduction would be the question itself. Is there anything like a good economy and a bad economy at all? Where can we decide if we are talking about a good economy or talking about the bad economy at all? Then the first main part is money. Is money credit or not? In which ways can we look at it to decide upon that, and where are the correlations? And then the most important things to know about money and credit, which you may keep in mind for future talks or for the experiment in the end. And then credit creation, how it works. Money and credit creation in the two-tier banking system, which is the system we are all living in globally. It's the rules of the game of the capitalist credit creation banking system. So maybe there's some of you already know, but others maybe don't know at all. Let's see, I'll just ask you in a minute. Then, and we will try the first experiment, which is if we have all that complex credit creation system sketched on the walls, and we try to cut out the middleman, which is something which is quite common in digitalization and platform and blockchain technologies, that all those new technologies are meant to cut out middlemen, whatever middleman. So we can find out some middlemen in the banking industry and cut them out. Let's see what happens. And the third part is a prototyping session. So, sorry. Okay. So before I dive into that, now that we are almost a full room, I want to get a first impression of who's in the room. So maybe you can raise your hands if you work or worked in a bank. Nobody. Who worked for banks? Me too. And who of you has ever heard of B corporations? Ah, that's quite much. And who has already quite an idea of what credit creation is all about? Ah, that's half of the room almost. And who doesn't? Ah, okay. Good to see. Who is using other currencies than the euro in his daily life? Wow. Which currencies are that?
West African franc.
Okay.
Ether. Ether, another.
New Zealand dollar and pounds.
Pounds.
Hungarian forint. Hungarian forint.
Oh, yeah, you got it. Great. Okay. And who is deep into the field of blockchain technology?
Not so deep.
Deep enough? Who never touched the field of blockchain? Okay. Well, so it's really a great mixture. Let's see what we can do with this great variety in the room. Now, the question I want to pose first, I am asked, I have been asked here actually by Sherman. She asked me in the first money talk. I don't know really this distinction between good economy and bad economy. I don't like that. It's quite moral, and the economy itself is neutral, so you can do either the other thing or the other. Everybody decides on his own, so the economy itself cannot be good or bad. And that's a statement I had to think about quite a lot. And then I struggled and I came up with quite some differences which I would present to you. So I think there is a distinction that you can draw. The distinction would be between the bad economy, which externalizes risks and costs and privatizes profits, and the good economy, which in turn offers a fair share of risks and costs and profits. Then the bad economy ignores the negative environmental, social and environmental and government impacts, while the good economy reduces the negative impacts and tries to maximize the positive impacts. And then, again, the bad economy is often a gain for the few, but a loss for the many, while the good economy is a gain for the many, and including a gain for the living environment, while trying to minimize the losses. And the bad economy is self-reinforcing and thus creating instabilities in the system itself and in the economy, while the good economy is self-balancing and creating resilience. So this is really a black and white picture, and there's, I think, many shades of gray between that, but you could summarize this that the bad economy puts profit before people and planet, while the good economy puts people and planet first, and then maybe there's a profit. So if you think about that, and consider the economic activities that you're all into, that we are all in contact every day with, you may see that most of the economic activities that we face are profit before people and planet. The sustainability theories have come up with different ideas of how to define what is good in terms of good for the planet and people. One is the triple bottom line approach. The triple bottom line approach is saying, under the bottom line of your balance sheet in your business, you have a financial profit, and there has to be a financial profit, and you also may look at the environmental profit or loss and social profit or loss, but in the end, what is important is that there's a plus in the end under the bottom line. The triple bottom line approach now says, okay, let's look at it a bit more fairly, and we put everything under the bottom line, so we want to see a profit in all three areas, but no loss in the financials. And what we do not really see is an approach where the environmental and social profits are key, are the primarily goals, and the financial profit or loss is somewhat which doesn't interest us at all. We don't see any economic activities at the moment which look at sustainability like that. There's another picture. This is the typical triple bottom line approach, or you could also say the ecological, social, and financial goals are three pillars. They all have the same weight, and they all need to be considered equally. And there's another approach, which is the Greifswalder Modell der Nachhaltigkeit, the strong sustainability. And strong sustainability means that things are embedded in each other. So the financial system or the economy is only a subsystem of society. Society, again, is only a subsystem which can only exist in an outer system, which is the ecology. So if we only look at the financial system, then society and ecology may suffer. If they suffer, the financial system cannot survive. So now, if we look at sustainability from that angle, and if we try to measure what is sustainable under the bottom line, then we need to find ways to assess and evaluate and manage all the operations, the economic operations, which lead to those numbers under the bottom line. And we have, so we can put exclusion criteria on the radar, we can use positive impact criteria, and we can choose assessment and evaluation criteria and processes to get there. I only mentioned a few. This one most of you know. This is the B corporations. They have the B impact assessment. This is a report from Patagonia, the outdoor clothes manufacturer company, and they do their impact report. So they report on governance, workers, community, the environment, and then they have an overall impact score. What is not on this sheet is the financial profits. So this is independently from the financials. Then we have the economy of the common good, the Gemeinwohlökonomie, quite similar to B corporations, a bit more detailed. So you have all those areas, and in all those areas which you have seen in B corporations, you also have subtopics. And subtopics grouped according to stakeholder groups, so which stakeholder is concerned. For example, the suppliers, or the ones who give the finance, or the employees, or the customers, or the wider environment, the wider society. And then this is a typical overview over the environmental, social, and government ratings. So this is mainly for investors, for financial products, and so on. And you have pillars, 3 pillars, which is environmental, social, governance, and the themes and the 37 key issues which are considered in this kind of rating. So you can already see it's all quite similar. It's not so easy as in financial balance sheets. You just sum up everything and then you have one number. But it's really, you have at least 3 or more categories in which you try to find numbers to assess the positive impact, the negative impact, and then sum up and weigh out against each other. And then one thing which may be very famous today already are the Sustainable Development Goals, which are clustered into 17 goals. And all those goals are sort of interim goals for a range from today till 2030, which the United Nations have agreed upon trying to reach in a way. So no poverty, 0 hunger, good health and well-being, quality education, gender equality, and so on. So you have those 17 different goals. Some are stronger, some are weaker. For example, this I find the number 8 extremely interesting and worth to discuss. That's the only economic, really, or economic financial aim which they have posed, and it's called decent work and economic growth. So economic growth is one of the goals for sustainable development. We could question that, but anyway. What does that mean for businesses if they try to follow that track? Businesses as singular entities or an economy, an ecosystem of businesses as a whole. So one thing is, if they try to become a good business, they are challenged by higher prices for their products and services because they are internalizing costs which others externalize. And they are internalizing risks which other companies externalize. Then they have an additional effort for the regular assessment and the evaluation and the management of all those risks which they assessed. Then they have difficulties to receive funding or credit due to their profitability, which is comparatively lower to conventional businesses. And then they need to compete against all those conventional businesses on the very same market for the very same currency to settle the debt which they have taken to invest in the first place. And the most important one from my point of view is that we have universal rules for credit creation in the economy, in the global economy. And those universal rules for credit creation, they do set profit before people and the planet. And if a good business wants to do good business and doesn't fulfill those rules, then it just doesn't get any credit. So, no credit, no business. So that was the introduction. Now let's get into credit and money. Let's see what ways there are to look at credit and money, and which of those perspectives you may share or find contradictory. So just give me a sign, something like yeah or ooh, or leave the room if you are disgusted. So one way to look at credit is so money. Money is what the 3 functions you all know, which are which have been told in all stories about money around the world, are money is a means of payment or exchange, money is a store of value, and money is a value measure. So you can compare things in price. And then one way to look at the credit idea is that credit is also one of those functions of money. So money could be a means of credit.
But that's more currency than, and well, people define money different ways, but it's more like currency is the means of money, depending on how you define it.
Okay, then we need another definition series about currency and money. So, yeah, you may be right, but depends on the definition of money again. So if you have money, money can have different forms, money can have different currencies, so you can have different types of money. And then there's a distinction between money and currencies and credit on the other side, which I think is more important than the one between money and currencies. So this is only a matter of which one is valid in which area and who cares to make it valid and by which tricks.
Yeah.
And the other thing is, what has that to do with credit? So depending on the currency you look at, you may see the credit function or not. So that's for sure. Then another way to look at it is that money is not credit. So money, you could say money is a stock dimension. It's a liquid asset. It's something that is there or it's not there. You have it or you don't have it. While credit is a flow dimension, which means money is sort of, it's something that is done, that needs persons to do it, that has a function of time. So credit is not just there. Credit is something that has a story. So it's a flow dimension. Then a third way to look at it is, while money is just the means to definitely settle a payment. So if you pay the price is paid, the money is no longer yours, but whatever you purchase is yours. So the payment is definitely settled. There's nothing open. While credit is the promise to finally settle a payment later. So you can already purchase goods now and then pay for them later, maybe even much later, or maybe even never. So now, as I told us a minute ago, money can have different forms. You can have money in the form of coins, banknotes, sight deposits in your bank, some units, some tokens, or you can even use cigarettes or potatoes or whatever you like as money, as long as there is someone who accepts what you offer as a liquid asset. So why do people accept money? Why do people accept anything as money? So there's one simple trick. Whenever you accept money, you only accept it because you know that there will be somebody out there who also accepts it. If you don't know anyone who accepts it, you will reject it. But if you have the expectation that there's people who will accept it after you in the chain, then you will use it as money. And that's how it happens with cigarettes and with potatoes between the First and Second World War, for example. And that's also how it happens with our newly created cryptocurrencies, by the way. Then, so if we look at the difference between money and credit, you could say money is one side of a credit contract. Money is the fully liquid asset, whatever form it takes, and credit is the relation between this fully liquid asset and a future liability. And you can say only if you have both. You have the liquid asset and you have a future liability. So you can pay with it, but you still have something open that you need to pay later, then you can talk about credit. And that's an interesting thing, because that's also what a bank does usually. A bank makes a balance sheet. That's a T account. That's called a T account. And on the T account of a bank, you have the liquid assets on the left side, the sight deposits. And on the right side, you have all the liabilities that come along with that. And everything that's on the right side, it's called debt. And this is only a number I just found yesterday. That's a really long number. I don't want to read it, but that's only the public debt we have worldwide. And this is the debt side. And now, guess the money side. Is it bigger, or is it lower, or is it equal?
No.
How is money defined?
Right answer. It depends. It depends which number you take, because what central banks do, central banks say money, so we have money M1. Money M1 is only the sight deposits. So only the sight deposits would be quite equal, like that number. Should be equal. And if you take money plus all the other forms of money and liabilities which come around with money, then you have M2, M3, M4, and those numbers are certainly much bigger than this number.
Do you need to explain what is M1, M2, M3?
Magic.
Does everybody know what it means?
Magic.
Maybe you can explain all the other M's, because for me the only relevant M for tonight is the M1. This is the direct credit, so this is really what relates to the monetary base. This is the sight deposit and the liability on the accounts. And then banks have other liabilities and assets which they take into account, and derivatives of that, obligations on that, and so on. So maybe you can explain it in greater detail if you think it's relevant for tonight. Otherwise,
Well, I think as far as I know, M1 is all the banknotes and coins and bank deposits in a particular currency. That's M1.
yeah.
M0 is the central bank reserves added.
No, M0 is coins and notes.
Okay.
M1 is that plus
Plus the
deposits.
sight deposits.
Plus sight deposits.
Yeah.
And then M2 is that plus less flexible deposits. I mean the savings.
Which have a longer term.
Yeah.
And M3 then I think adds the obligations and all the kind of debt, transferable or tradable debt kind of things which can be used as money. But the thing to understand about this is that all central banks struggle to define that themselves what is the useful kind of money to manage. If you look at the policy of the Bundesbank, all throughout the last 30 years, they've been changing all the time
Yeah.
the money aggregate they're working with. One time it's M1, then it's M2, then it's M3, and etc. etc. They never really know exactly which one they should be managing really. And that is the big problem. It's very difficult to define what exactly is the useful aggregate of money. And it's also very difficult to define money, because if you try to define money in a certain way, then the market keeps inventing new forms of money.
Which is what really happens, by the way. Yeah. So thank you for clarification, and I think we'll get back to this a few slides later when I show you all the different kinds of monetary elements we have in our banking system, which are considered money. So if you look at commercial bank credit, commercial banks, as everyone knows them and has their accounts, we have on the right hand side the promise to pay, which is the bank debt, and on the left hand side we have the money, the liquid asset, the sight deposit. So this is basically what banks do. They create sight deposits, and by doing so they also create bank debt. They are not creating money, but they are creating sight deposits which we use as money. And that's important to know, because there are other forms of money in the banking system which are not directly connected to the conventional banks, to the commercial banks, which are banknotes and coins, which is the M1. We have the digital bank money on accounts, because every commercial bank needs to have a bank account at the central banks, and that's another money which does not leave this accounting system between central banks and commercial banks and does not get into your hands. And then we have on the other side also other kinds of liabilities, like for example government bonds, or central bank facilities, which is credit which the central bank gives to commercial banks in order to refinance. But we'll get back to that later. So this is only to show you there are different kinds of money and different kinds of liabilities in our banking system. And then there's also something like non-bank created credit and non-bank created money. So whatever settles your payment, the units, the tokens, the cigarettes, some kind of bearer bond. So I bear this bond and I can cash it in your house or whatever. Promissory notes, IOUs, coupons, vouchers, you all name it. And then you have the liabilities on the other side, which can be just a redemption commitment. So I hand out a voucher and I just commit that you can redeem it in a certain period of time. You have the obligations. You have some structured obligations like the collateralized debt obligations, which have become famous within the financial crisis. You have the collateral itself. So collateral is some kind of security which you bring in to the bank to allow the bank to create credit for you, because the bank wouldn't do that just like that. They want to have some kind of security if you pay to refail, and then they want to get hold of your collateral. Why is that important? Because if you have given this collateral to one bank, you're not allowed to give it to another bank as well. So you can only use collateral once. You could put collateral on a blockchain, by the way. So just to make sure that it's only used once. Then other kinds of liabilities, whatever is promised through a bearer bond or a promissory note or an IOU, I owe you something, or a coupon or voucher. So this is all credit which is created without a bank involved. Or maybe banks are involved, but they don't need to be involved in that. So, as I said before, if you can draw a T-balance, it's credit. That's really one message I want to share tonight. If you have a T-balance, it's credit. If you can't draw a T-balance, it's just money. It's just a unit, just a token. That's the T account. That's exactly what you see here. So you see that yellow T on the wall? So that's the T balance. If you can draw a sheet and put on top, you put who's crediting, so whose account is this, and then you say this is my money, this is the liquid assets which are created, which I have on my account, and then this is the liability which I also have on my account, which I need to fulfill later. Whenever you can do both, and these are related to each other, so you only get the money if you fulfill the liability, or okay, you can offer a liability, I can give you money in that dimension, right? Whenever you have both, then it's credit. When you only have the left side, you have money, you have a liquid asset, but you don't have the liability to pay something later. So when I pay you with a unit or a token, then I give you the liquid asset, but I don't give you credit. I just hand over money. But in order to create that money, I maybe needed a T account first, which allowed me to create the token which I handed out. And whatever rules there are, the credit rules are the rules that need to be fulfilled in this contract. This can be the contract which is typical for a commercial bank. It can be a contract typical for a central bank, which has other rules to follow and other freedoms. It can be rules within a blockchain-based system or a platform co-op or whatever, right? So whoever defines the rules, every account needs to follow the same rules, and then you can create the same currency on the same basis of credit rules. So if we now look in the banking system, we find all those different types of money and currencies and credit and so on. And it's really quite a mess if you look at all the different things. And this is only this is only a part of what is relevant. So this is really only what I want to show you tonight, because all the structured obligation stuff and all the different tender types and so on, there's more to it than that. But that's the banking system we live in. We have digital central bank money, which is offered on central bank accounts, and the issuing institution is the central bank. Certainly the legal status is central bank money. And you can look at the whole money supply through those columns. So you have what we use as money. I put a frame around that. Is cash plus sight deposits plus, which is an extra thing, digital cash or e-money, which are sight deposits which you put into your wallet. So when you put them into your wallet, they are no longer on your account, so they are no longer sight deposits. So this is another type of money, but they are also connected. So we have in our banking system 5 to 10% cash and 90 to 95% sight deposits and digital cash. And maybe the numbers are not fully correct, but this is only just to show you a rough relation between those. So cash, meaning coins and banknotes, are the smallest part of what we use as money. Coins, by the way, are issued by the state, so coins are state money, while banknotes are issued by the central bank and are central bank money. Which is another difference which maybe nobody knows. And it's not relevant at all in our daily lives, but that's what our banking system is structured like, and yeah, you could do it differently, but that's how it is. Then you have sight deposits on bank accounts and the bank money tokens. The tokens, so the bank, what is relevant is you have here a promise, the sight deposit, a promise to deliver legal tender central bank money while supplies last. So if there's no central bank money available because there's only a certain liquidity reserve, so there's no central bank money. But then there may be Angela Merkel, and then there may be more central bank money the next day. And you have the bank money tokens, which are also a promise to deliver money, but also only to deliver bank money. And those two, again, are the promise to deliver legal tender money. And then?
Can I ask you a question?
Yeah.
When you said we, you mean us Germans or Europeans, or is this a number for any kind of country? Because I guess that differs quite a lot, doesn't it?
Well, this differs quite a lot, sure.
Yeah.
Yeah, maybe in some countries you don't even have digital e-wallets, e-money wallets. I don't know, but the main point is cash is only a fragment of what we use as money, and then what we use to make payments is even more than that. And then we come to the point of management. So what does the central bank manage? What is the central bank able to manage at all? And the central bank is actually only able to manage this official part, the monetary basis. And then central banks are trying to influence what's happening in the commercial banks on sight deposits and digital cash. And they're trying to do this via the conditions for banks to hold official money and via the price for official money and the quality of official money. But they are not really interfering with the bank's direction. So what we used to make payments with is with cash, with sight deposits, with digital cash, and with third-party credit, which is given by non-banks. So what can be a promise to pay by a non-bank? Do you have any idea?
Promise to pay by a non-bank.
Yeah. So a promise to pay later.
If you have a job, your employer promises you to pay later, and they're not bank. But I don't think you mean that.
I'm not really meaning that, but that would be a business example. So one business is asking you for credit, so you give your labor first and then you get paid later. So this is a kind of credit. You could be paid every day, but you allow the business to have an extended payment deadline of 30 days, right? So, but there's companies which offer that service, which is credit card companies, which is PayPal, for example. With PayPal, you can just click a button and opt in. That PayPal will ask for your money 14 days later. So you can buy today, but you only have to pay 14 days later. The credit card company is at the end of the month. So you can buy everything for the conditions of the credit card company, but you only pay, it's only settled at the end of the month. So their credit is created beyond what banks really do. So, and as I told you, this below here, this is monetized credit, or partly monetized credit. What banks do, commercial banks do, they monetize credit. They create something which you have on your accounts and in your e-money wallet. Third-party credit is different, because if you have a credit card, if you pay by credit card, and the company settles your payment, you don't get any coins or notes or tokens which you can use in the meantime. And even the credit card company doesn't use your money in the meantime, so there's no monetization of that debt. That's really only a credit feature which they use. But banks, commercial banks, are the ones which are allowed and licensed to monetize credit and care for our money supply. So the 7 most important facts, you have already heard some of them. The credit is a promise to deliver money later or to settle a payment later. But if you pay with money, the transaction is settled. If you pay with credit, the payment yet has to be made. And then another important thing. If you look at the economy as a whole, payments are made with money or with credit. So the total spending power that you have is money plus credit. And that's something which central banks cannot really manage, because there is credit which is created out of the banking system. That's why they struggle to manage the right quantities. So there's no direct relation between the amount of money in circulation and the overall economic activity, the GDP, which we have. But if you add credit to the picture, there is a relation, because all spending is done by money and credit. So one theory which is quite famous is the multiplier theory, so that you relate the monetary base to the economic activity, saying that, okay, we can have a turnover of money, a money velocity of 1.3 or 2 or 4, and then by measuring the velocity, you mean that with a lower monetary base, or with a lower monetary base, you create the same economic activity, or with the same monetary base, you create a higher economic activity. But that's really misleading, because it doesn't say anything about how much economic activity is fueled by the complete spending power. The complete spending power is not only related to the monetary base. It's really the monetary base plus credit. And then you're there. So forget about the multiplier. That's my thesis for today. Then changes in credit and money supply have the biggest influence on the economy. Why do I say that? That's, for me, that's really a very important thing to consider. If you want to change what is produced tomorrow, you need to buy something tomorrow which does not yet exist. So how do you get anyone to produce this? You need to give him credit. You need to finance the production. You need to pre-finance the production. So as long as you just wait for things to change, things change slowly and slowly, because someone needs to save, and then by having enough savings and collecting savings, then he can maybe open a new production site and produce something in a completely different fashion than before. But if you have credit, you can finance this directly today. And there's no limit. There's really no limit of what you can finance today if you want to change something for tomorrow. The only limit is the time to really build it and produce it. The credit can be created from scratch, right here, right now, like this. Okay, you want to build something in the desert, a new power station, solar power station. The credit, here it is. So how do we do that? The credit, here it is. Well, we do this because credit means belief. I believe that this will happen. I believe that you will manage to build this power plant within this time frame which you promised. So I credit you. I'm a bank, I credit you. Or I'm a creditor and I credit you. You're the borrower, here you have the money. How much do you need? 1,000, okay, 1,000. 10,000, okay, 10,000. Just pay it back later. Here's the conditions. And then we're there. And because we have credit, we are also inducing growth in the economy. And we are inducing growth in a manner that we create dynamics, we create cycles, we create boom cycles and bust cycles. But on the average, we are creating growth by just issuing credit, by just crediting what will happen in the future. By crediting it, we have the liability that this will be fulfilled. So if we credit something for growth, growth will be fulfilled because that's the liability. And that's what we do in our economy every day. Another important fact, credit creation does not need anyone to save in advance. There's no need to have savings. This may be contradictory for some of you, because if you have studied economics, you have learned, okay, there's a relation that's called S equals I, savings equals investment. So as much savings we have, as much investments we will have. And in a system of credit creations, savings are not at all a precondition. You can just create credit. And then you may still have savings, and savings may still even be needed to refinance the credit that you have created, because otherwise banks would become illiquid from the point of view of a central bank. But they are not essential to create credit in the first place. It's rather the other way around. So savings need someone to have created credit before. Otherwise there wouldn't be any money to be saved. And then, relating again to the credit card companies, credit does not need any money to go around. So you can create a system of mutual credit where you just keep your books. You just write down who's owing what to whom. You don't need to have any coins or notes or units to really change the owner. And credit creation does not need banks. It can happen between non-banks, it can happen between individuals, it can happen completely off the radar of central banks and of the banking system. So that was the first block. How are you? Who needs a break? Okay, so shall we continue with credit creation in the banking system?
I have
So-
a question.
Yeah.
I want to ask, I don't know, I need something to be clear, but shouldn't you said that credit is used to create credit also?
credit is basically used to create money.
To create money, but
Yeah.
you said at some point credit is used to create credit. Is that true?
Did I say that? Can I have the record, please?
No, okay. Yeah, because if I heard that, then maybe it was wrong.
No.
I mean, the
No.
banks use, yeah, because I thought then like how, because you said that banks, it's hard for the banks to measure, to deal with that at some point, you said something like
It's hard for the central banks
Mhm.
to really manage how much credit the commercial banks can create and do create. The thing is that commercial banks, the credit that commercial banks create relates to the monetary basis which is offered by the central banks. But they can do so without interference by central banks. So they are on the first step of the ladder. So they can just decide if they credit you as a borrower a certain amount of money, then they put it onto your side deposit, onto your account. So they have created a claim on money, which you can use as money. So you can use the credit to settle your payments without the need of having official money in your hands. You can really directly use your credit as money. So, credit creation in the banking system. What's that?
I have a
That's an egg. That's an Easter egg. No, that's basically your account. It's a zero. It's an account of somebody. Somebody's account, which is just flat. It's just a circle. So now we are creating credit on this account. How do we do this? We just put the liquid assets on the one side, which is money, and the liabilities on the other side. And then we just flip it around and it looks like that. So we have our T accounts. We have the liquid assets on the left side, and we have all the liabilities on the other side. So I just put a plus and a minus, which is different from banks. Banks just put everything in positive numbers, but just to show you the relation. And then we have somebody else who has the same account, has the same balance or different balance. And then those two are doing a transaction. And in the transaction, the liquid asset changes its owner. So it goes from one account to another account.
So you
Yes.
mixed up the
That's already
plus and
understood.
minus?
Yeah, I mixed them up. Here.
Okay, good.
I fixed them on the next slides. Yeah. Here.
Okay.
Yeah, here's right. Ignore the other two. So here's right. So you have the same balance in the beginning, which is, okay, you have 100 on your account and you have a liability to pay back 100 whatever day. Maybe it's an overdraft account, right? You have an overdraft limit of 100 and you already have 100. So you pay with 100, the other one gets the 100, and then on top there's a roof. What is that?
Okay.
That's the bank, and the bank has their own balance sheet, and then it just sums up everything. So all the assets and all the liabilities. It's very, very much simplified. I don't know if it's really like that in the bank, but that's what basically happens. In the bank, you have accounts for individuals, and you have a collective balance sheet. Now, there can be more accounts under that roof, and then they're all just added to the same bank balance sheet. So now what happens if we have two banks? So we have accounts in one bank, we have accounts in the other bank. You still can do a transaction from one bank to the other bank, but then you have different balance sheets in the banks. And that's a problem. what should they do?
The banks are moving the money and not the accounts.
Have another P. Where one bank credits the other bank.
Central bank settles.
It's a gray area.
I know that's really everyday business for banks. And what they do is they exchange liabilities. Or they exchange money to settle their differences, to balance out. So the banks balance out between themselves. That's called interbanking market. Banks buy what they need from other banks, or they sell what they have too much to other banks. They sell it on the open market for a certain price. That's interbanking. But you mentioned it already. You could also have another T balance, which is on top of that. And this balance on top of that is the balance of the central bank. And the central bank says, okay, I have another balance for you. And you're also even forced to have this account. And in order to empower you to balance out your accounts if the interbanking market fails, you can always, in any moment, no matter what happens, you can always settle your accounts with central bank money, which we offer. But then it's our conditions and it's our price, and so you can have a short-term tender to settle your accounts for a certain price. You can have a long-term or a medium-term tender, an overnight tender. You can also park your additional money in your central bank account, and all that can have a certain price. So when the central banks want you to park their money, to get hold of their money in their accounts, they have a low price. Then they want you to ask other banks in order to keep all the liquidity liquid on the market, to spread it out and make it available for others. Then they set a high price. And if they want you to park their money, to park your bank money in a central bank account, you can do this for a zero fee. But if they don't want you to park money overnight in the central bank to settle your account, to balance it out, they can set a high price just to park your money, which is called a demarge or a negative interest fee, right? Which is what central banks installed just a few years ago. They never needed to do that before, but now in a zero or low interest regime, they needed to even make parking money in the central bank unattractive. So if you can add more to that picture, you can add another central bank on top, which is the European Central Bank, which has national central banks below, and so this central bank has other balance sheets like the Target 2 balance sheet, where you can balance out or not balance out all the different balance sheets between different central banks in Europe. You can have government bonds, which are used as liabilities to create additional money. You can have outpayments, so if you withdraw money from your account, it's not on the account any longer. No bank knows what you do with your points and notes. You can have in payments, and nobody knows what happens in between. And you can have all the non-bank credit. So this picture is really complicated. But in the end, you know that credit does not need banks. So let's cut out some of those middlemen. What can we cut out? We can try to cut out the upper level. So we already saw banks can really handle this on their own, central banks can handle this, and banks can handle this on their own without a central bank on top, just by replacing the central bank by a smart contract. So you don't need any Alan Greenspan or whoever with this glass bowl saying, we will change our interest rates maybe next time. But we don't know in which direction. And maybe my shoe tells you. No, it's really, you can have rules, direct feedback loops and indirect feedback loops, and put all this into smart contracts, which is not really trivial, because if it was trivial, central banks would be able to manage monetary dimensions much more easily than now. But in theory, this should be possible. The management, the balancing out between banks should be possible with a smart contract.
Are you saying that it's a better, you're proposing this is a better system? Would it be better to have credit creation without banks, or just it's possible?
Well, this is really just, it's possible. And if it's better or not, so if it doesn't work, then the smart contract is bad. So it only works if it really leads to a balancing out between commercial banks.
Yeah.
If the smart contract fulfills that, then it's a good smart contract, and then it may be even better than central banks, because you don't have subjective people doing subjective decisions and communicating about them in a manner, let's say, in a grammar and vocabulary which others try to interpret in order to take action on a basis of expected changes, right? So what central banks do is they minimize the communication, but then everything which is communicated is so important. Because everything which Alan Greenspan said could have meant something, so we need to react on whatever he says, and if he twinkles or not, this may mean something. But if you make a smart contract, the rules are transparent. So you have more or less a transparency central bank policy instead of an intransparency central bank policy. And this should be better. From, let's say, from a theory of markets, where when all market participants know all about everything, then things equal out much easier than when you have an imbalance in knowledge on markets. So this could apply here as well.
I have a question. Isn't that what Ripple, the currency, the cryptocurrency tries to do with this territorial?
It's something that Ripple would be able to do. I don't know if they really prototyped it already. But I know that this has been already discussed, the issue of using blockchain and smart contracts to replace central banks has been discussed last year on a conference. In the Blockchain Economic Forum in Switzerland. But you can also cut out the banks, the different banks, and just put one bank for all. So why should we have different banks at all? Why should we have so many types of commercial banks if they all just offer the same thing? They offer credit, and they offer money on your account, and they request the liabilities, and they request all the assets and collateral. So why should there be so many different banks? Yeah?
Competition, diversity, stability, variety.
I fully agree. But you don't have really variety, because they all have the same product, the same rules, the same regulation, they need the same liabilities and so on. So the variety is, in terms of the products, yes, but in terms of credit creation, they all have the same thing. There are 5 types of credit, and that's it. And so my thesis is that we do have so many different banks because in earlier times it has been very difficult to manage accounts for people in different places. So you needed different banks in different places, and then you had different needs between households and businesses and huge corporations, so the needs were very different. So you had sort of a variety of needs which were answered by a variety of different banks. And then those banks all tried to push onto the same market, which is every bank offers everything. So the variety, the diversity somehow changed or disappeared, at least is disappearing, I would say. And then the capacity of banks to manage accounts and manage data has risen with technology. So a bank in the early ages had to do all this with her books and then with her Excel spreadsheets, and now it can all be done online. You know, N26, it's one online bank. No matter where you are, you don't even need to go to any place, you just do everything with your smartphone. Why does that work? Because we have communication technology. You can insert and manage and and calculate so many numbers as it was never able before. So this could also be an
Can I ask
option.
a question?
Just not saying this is the good option.
So if you talk about N26, and you earlier talked about how central banks can't really control the amount of credit created, can N26 create 10 trillion euros of credit today? What limits the amount of credit N26 control?
Yeah, well, N26 is regulated.
Yeah,
It's a fully digital bank.
yeah.
So it has a license, which is an e-money license. So they can do everything that banks do, but they do it on a very huge databases. They do it everything online. So they do many things differently from commercial banks as we know them, but basically on the technology side. So they're not doing anything else in terms of credit creation. They're just more efficient, cheaper, maybe.
But they give loans, they create credit.
They can create credit.
Yeah.
But they can't do it unlimited, because if someone transfers to another bank, they wouldn't settle with from one bank to the other. So they have to go to the central bank to get it settled. And when I have $1 trillion from N26 and I send it to you,
Yeah.
26 is owing your money, your bank, $1 trillion, and that they have to find a way to settle it. And
Exactly.
the European Central Bank or whoever is responsible wouldn't just let them settle $1 trillion out of nothing.
Right.
Or tell them-
But that's due to the fact that we have other banks. So if we only had, so imagine we only had N26 and no other banks, then everybody would have an account in N26, and nobody would have any account outside of N26. So where would you transfer your money? From one account of N26 to another account of N26. And everybody could only do the same.
But then we had a single point of failure. So
And then we had a single point of failure. Right. So that's what I'm saying. We could do this. We can cut out all kinds of middlemen, and then we will have consequences or risks. And what we also can do, we can even cut out that institution, the N26, and create a platform where everybody, just simply everybody, can create loans, can create credit, can create money, and transfer and settle payments between each other. So you can also just offer a platform, so there's no institution that really manages the risk. The consequence is, all those credit creating institutions, which would be you and me and everybody else, and maybe a business or whatever, they would be forced to manage their risk on their own. Or maybe there would be others on the platform who are just offering them a service to manage their risk. And then we could also get rid of the platform, because a platform needs an owner and an operator and a manager, and we can just put all this on a distributed ledger. You could say, okay, distributed ledger also needs to be offered by someone, yes, but basically on a blockchain or a distributed ledger, everything can be managed by smart contracts. So if you just set the rules and then let everybody just access this this type of ledger, then everything can happen within this room, within this credit balance. And basically what you would have is still the balance sheet, still the T account. But it would be a very long T account because everything would be on the same ledger and everybody would be able to look into that.
I think you're missing one important part of banking because they have a legal team. They're able to sue you, bring you to court, and enforce your debt with police or jail time. So I think in the last two versions you showed up, everyone would get rid of banks, but you would need his own lawyer or his own legal team or something
Yes.
like this. So you would just transfer the power to some legal structures that would enforce these contracts.
Exactly. So you would, on every stage where you cut something out, there's a certain risk which needs to be redistributed. So either you redistribute it to another level or to every single party involved. And that's for all those steps, that's exactly the case. So you can create credit on all those levels. You can create credit without banks. You can create credit in one bank. You can create credit in a two-tier banking system or something even more complex. But you always need to look at the overall picture. So where is the risk? Who manages the risk? Who takes what risk? And then the picture is complete if you really look at all those aspects. The important thing is that that you understand that creating credit is possible even besides the banking system, and it's possible even without banks, and it's just something that we can design and we can find ways how to build credit creation systems with banks, with central banks, or without them. This is something you see that I relate to that with my pictures. This is something I already stumbled upon when I first dived into the topic of money at all, which was in 2005. In 2005, there was I was in 2003. I was in Naples, and I took. I attended a competition, an architectural competition. I'm an architect. And the architectural competition was, hey, look at all those shrinking cities out there. There are cities which do not develop any longer. They seem to shrink and nobody can stop them. There's an economic downward spiral, nobody knows. But what can we do, we as architects and urban planners, what can we do in cities and regions like that? And when I looked into the causes which led to a phenomenon of a shrinking city, I understood that this was due to economic self-fulfilling prophecies. So it doesn't happen like, I don't know, a thunderstorm. It's nothing natural. It's really a matter of social dynamics. If you have a region where you have a boom, a tendency of an economic boom, you will always find investors to jump in and set another 10,000, and banks who create another 10,000 of credit. And by doing that, they enable the boom to happen. And by enabling the boom to happen, the expectation is fulfilled, and everybody sees that the expectation is fulfilled, and so they extrapolate this into the future, and they say, okay, we will add even more. This is why metropolitan areas grow, while rural areas are sort of right out. So there's nobody stays in the on the land. Everybody goes into the cities because you can only gain a profit there, you can only make your living there, you can only get your wages there as an employee. So And at that time, I understood that in order to stop those regions shrinking, the only way to stop them shrinking is to create credit for those regions. There must be some way to create credit in a way that those regions can stop the downward spiral and recover. And you cannot do this within the same system, within the same currency, within the same credit creation system. You need to reprogram credit or add another type of credit which is really bound to that region and allows that region to really write another story of growth, which is an independent story, independent of the global economy. And it was at that time when I stumbled upon regional currencies like the Chiemgauer, like the Berliner. So we had so many regional currencies at that time that I made a small cards game, playing game, a quartet. Some of you know quartet spiele. So this is a cards game on all the regional currencies which have existed in Germany and in the German-speaking countries, plus all the ones that have popped up during those years. You can just give it around and have a look. And some of those, which is interesting, these regional currencies, there are different types. Some of those are really only tokens, like we know them now from the ICOs and cryptocurrencies. They're just printed on paper saying, okay, you can just pay in my shop, and that's it. But others really have a credit feature. And it was already at that time that people did not really understand what was the difference. But when they understood, they were sort of hesitating because they didn't know what was happening. They didn't know which type of currency they were expected to accept. And there was one experiment, the Vollmetaller in Hagen, which tried to do both. So they tried to convince people to accept a currency which was really exchangeable one by one to the euro. You could just buy them and then bring them back and get your money back. And then after 1 year, when they distributed that currency, which was quite easy for such a currency because when you can always cash it back in, there's no risk. After 1 year, they offered another Vollmetaller, which was still a Vollmetaller, but had something written on the note, which was a little bit smaller, which meant, okay, this Vollmetaller you cannot exchange back. This is credit created. And they thought they could just spread this currency, so to say, on the way of distributing the other currency. They could also implement the credit creation currency. And people got rid of both within 2 weeks. So nobody accepted that currency anymore. This experiment clearly failed.
No, it was a win. They learned a lot.
They learned a lot, exactly. And then there were others which really started from the beginning with a credit creation currency saying, okay, we offer you a certain amount of that currency, like for example the Broteinheit, or which one was it? The Urstromtaler, for example, Urstromtaler in Sachsen-Anhalt, Saxonia, and so Eastern region, all structurally very weak. So structurally weak meaning not credit-worthy. So he just issued credit from legislation. He just issued credit to companies, giving them additional liquidity to settle payments which they would otherwise not be able to settle. And he tried to distribute that currency, and it was really hard. He tried 5 years, he tried 10 years, and he added one business after the other. And I don't know, I think it still exists, but it didn't grow really fast. grew so slowly that nobody really was interested in using this currency in daily life. All the businesses which he could convince were at such a distance to each other that nobody would really take the effort to go to that business just to spend their Vormittag. And they were not connected along the value chains, along the supply chains. So you just needed to hand it over to somebody else who might be able and willing to spend it one day for something that he wouldn't have bought at all otherwise. So it was really hard to get those connections. So it's not easy to create a credit system. But during that time, I also stumbled upon this. This is from Michael Linton. Michael Linton is one of the inventors of the LETS system. And LETS means Local Exchange Trading System. The LETS systems are distributed over the world. They're quite famous today. And basically what LETS systems do is they say, come into my club, and within my club, you are all allowed to give each other credit on this account.
Computer.
No, you have to.
It's mine. This time. That's the currency, the energy is all.
Electricity is a form of currency.
Yeah, it is. Or it is not, it's an asset. Yeah, basically what happens in a land system is that everybody is allowed and enabled to give each other credit. So they have one system of accounting where everybody balances out with everybody else. And this is a form of credit. But it's not a long-term credit as we know it from banks. It's really an instant credit, so I can buy, I don't know, I can buy your beer today, and you just credit me the amount, and then I'm in debt and I can somehow fulfill some other activity, gain some money on my account, and then pay it back. So I can just settle my debt, which I created in the instant when I bought your beer. So that's a LED system, and I really found those pictures very convincing by Michael Linton, where he just showed how the network works. We just have those balance vectors in the credit system, which is something that nobody else had in mind when they created regional currencies at the time. Almost there. So here we are, it already changed. And that's the thing with systems. After a breakdown, they're always different. So okay, what does this mean for us today? So technology has changed since 2005. It has changed a lot. We now have cryptocurrencies. We have blockchain technology. We also have post-blockchain technologies like holochain and I don't know, Tangen and stuff. So, what are cryptocurrencies considered in this definition which I showed you before? So cryptocurrencies basically are fully liquid assets. I don't know any cryptocurrency which has been issued differently than being a fully liquid asset. And it can have the name of a coin, a token, or unit, it doesn't really matter.
There are some reputation coins.
Reputation coins.
Reputation coins. So they are not currencies, but in other.
Yeah, okay. So you cannot transfer them.
No.
Okay. Then this would not be.
Then it's not a currency.
Then it's not a currency. No. It's another medium. So I don't know if you know systems theory. In system theory, the general assumption is that a system, that we have systems and subsystems, and every system consists of boundaries. Boundaries consider what is happening inside and happening outside, and you have certain rules for what happens inside, and you have a medium of communication for what happens inside. And such a medium in an economic system, this medium is what we call money. A reputation thing would be something different in systems theory. So to take this definition, I would say we're talking about monetary medium, and a monetary medium would be a cryptocurrency used as money, or usable as money. So we have those types of cryptocurrencies which are fully liquid assets. Then they are distinct mediums in closed systems. So they are different from others. They are really, it's clear that you have something which cannot be confused with other items, with other liquid assets. And you have those specific set of rules. And then you have the at least two typical types of creation of those liquid assets, which is mining, which would be a fiat asset creation for the service, be it proof of work or proof of stake. So you all know what fiat means? Somebody? Okay, so fiat lux is Latin and means let there be light. And fiat money means let there be money. So it's just created like that. In that case, those assets haven't been there before. Just by proving that you did your work, that you calculated the algorithm and so on, you are credited the asset. So you get the asset just as a bonus for your proof of work. Then you have the typical ICO, the initial coin offering. An initial coin offering is a type of credit in a way that it creates credit for the ones who supply the whole thing, the ones who supply the whole infrastructure. So the suppliers offer coins and you credit them. So if you buy those coins, you credit them for the work they haven't done yet. And this allows them to start the work and to build everything that they have promised. But what is very typical for cryptocurrencies is that you do not find any T accounts for the users. So the only T account I find basically is here. There may be exceptions, but I'm really curious to learn about all the exceptions from you. But the ICO is the only T account which they all share. As soon as a cryptocurrency has an initial coin offering. So the core question in all this remains. The core question is, who creates what kind of money or credit, and how, and for what purpose? And And this leads me to the third block, which is credit creation as a force for good. And I started very basically, again, with what I showed you in the beginning, draw a distinction. So are you creating credit as a force for good or not? And if yes, what do you mean by that? For good means for people and planet before profit. And how can you draw this distinction? So what maybe most of you know that we do have something that is called ethical banks. Christoph knows it very well. He knows many ethical banks. And I always get posed the question, so why do we need to talk about those credit things and currencies and so on? Why do we need to talk about this at all? We do have ethical banks, so we can still finance. Actually, they are very, very successful. They have the highest growth rates in members, and so they're quite profitable and so on. Why do we need to talk about all the other stuff? Yeah, well, those ethical banks, they are just one bank within that system. They do need to balance the same liabilities and bank money as all the other banks, and they are regulated by the same central bank and by the same banking system. So the potential is that they are creating credit for good businesses. That's really what they do. Although some of the ethical banks have not yet understood it. They think they lend money from savers to borrowers, but actually what they do is they create credit and then they refinance that credit. They do have a client community which shares the same values. That's another potential. But on the other side, they have very strong limitations. They are under the same regulations as conventional banks. They only offer, they can only provide credit for a small niche because most of the credit created is profit first. But it's not because people wouldn't request it, it's just because it's really hard to provide credit which is not profit first in a system which requires you to offer credit for profit first. And then in order to do that, they need altruistic savers who compensate the lower price for credit by a lower interest on their savings. So if they don't find enough altruistic savers, they cannot finance enough good projects, or it's really hard for them to find some. Then what I also told you, that all those borrowers, all those companies which are credited by an ethical bank still compete on the same market for the very same currency against all the other companies which have been financed by conventional banks. So ethical bank credit is still commercial bank credit. Now, how can we use credit creation as a force for good? My thesis is that we could do that by offering distinct credit creation. What do I mean by distinct credit creation? I mean that this type of credit must be identifiable as a different type of credit or money. It must be created according to specific rules. For example, people and planet before profit. It must not be confused with conventional bank credit or bank money. And it cannot get used to settle conventional bank debt. So it cannot get lost from the ethical banking system or from the good economy to the bad economy in order to settle their debt. No, it can only be used to settle the debt that we create in the good economy. And then it can or should be used as a medium of payment. So as you know, credit can be created also without monetizing it, but this makes things much more easy for transactions. So I call this impact credit. And impact credit because the money is the message, right? So this is credit created for impact, so it's impact credit, basically like that. And in an impact credit T account, you would have impact assets on the left side, which is impact site deposits, impact tokens, impact units, impact banknotes, impact coins, impact central bank money. You can put everything you like, or you can also cut out again some of them if you don't like them. This is only the full range. And on the other side, the promise to repay the liabilities should be impact bank debt, impact obligations, maybe impact CDOs, impact bearer bonds, impact IOUs, impact coupons and vouchers, and redemption commitment for impact credit.
I'm sorry, I don't understand what impact means.
So it's the good impact.
The good.
The good impact. Social impact, environmental impact, positive impact for people and the planet. So now there's many ways to roam. As I showed you before, this is just an overview again of what are the different possibilities to design credit creation systems. So you can do it with a central bank only. Yeah.
Gewaltige Präsentation.
Sure. You can do it with the central bank only and cut out the commercial banks. You can do it with the commercial banks only and cut out the central bank. You can create a banking club, for example, put all the ethical banks together and all their communities together. You have a number of banks and only one type of credit and currency. You could create only one bank, one currency, like the M26, but with its own distinct credit system. You could ask the state to issue impact credit, to issue not only green bonds, but green and social and whatever bonds, and issue those in a way that they can be used as a means of payment. You could ask individuals or peers, you could implement something like a mutual credit system between peers, which is only dedicated to good impact. You could go to the producers and enable the producers to create credit for financing all the economic activities along their supply chains. You could also ask something like a community, like a platform co-op or a whole movement to build a platform that offers credit services and everything around it just for the impact-oriented economy. So now I would invite you to take a break and then start to think about all that in a co-creative way. So find yourselves into groups, and I don't know, we can have 4 groups, I think, in this room. And in those groups, in all of those groups, you just take one of those examples. So who are you to create credit? Are you a banking club? Are you the state? Are you the peers which are having their debt system or platform? Or are you the central bank only, which is offering one kind of credit? Or are you the producers? You can just pick one. But so in all of those 4 groups, we need one type of credit creator, and everyone who is attracted by that type of credit creation. So I can imagine, yeah, let's see what would happen if we put all the ethical banks together to create a distinct type of credit. Then discuss this in your small group, and then we will see what happens. So we are the credit creators, or we are the bank. We are creating credit for this purpose. What do we do? What do we put in our T account? And what questions do arise when talking about that? And I will try to experiment with you where we get by just experimenting, finding out what the open questions are. So, thank you very much.